This next stock we'll be screening looks overvalued, just by the looks of it. But is it really? Let's confirm that to our three metrics. The stock is Waste Management, or WM. It is currently trading at $155.67 with high price of $168.04, current market cap of $64.54 billion with PE ratio of 36.25. They give out an annual dividend of $2.6 per share, a yield of 1.67% of the current price. First metric, we want an EPS multiple lower than 3. It's 8.45. This is expensive, but is it worth paying for? EPS multiple is PE divided by EPS. We want it lower than 3 because we don't want to be overpaying for a stock. We want EPS increasing and OSN, or number of shares, decreasing. If you're in it for the dividends, I'd say it's safe around 60%. Second metric, we want to pay $1 or less for 1% of the money they're making, meaning we want to pay 1 PE or less for 1% of their lowest margin. What you see here is revenues deconstructed. You're familiar with this. Above values are in billions, below are in percentages of their respective revenues, or what they would call yields or margins. I'll show you the relationship of the cells. Of the four highlighted values, we'll use the lowest margin to divide our current PE, and we'd get a discount of 3.58. This means we're paying 3.58 times their yields if we buy the stock at the current price. That's crazy expensive, guys. This is overvaluation, guys. It's overowned. They're not selling because of the dividends, of course. I don't know what will bring the stock price down, but it has to be the EPS. It has to be increasing way more. This is crazy, guys. You're paying for this 3.50. I'm surprised the company is buying back shares, even at overvalued prices. Although they're buying very little every year, but it's still overvalued. Looking at their margins, I'd say 8, 9, 10 is the perfect entry PEs for the stock, given my margin of safety. And that's not even by much. Third metric, we want to know our discount compared to when the markets have valued the stock before by looking at their historical PEs. I took this data from Guru Focus and Macro Trends. We'll take the lowest PE to divide the current PE, and we'll get a discount of 1.71. Again, this is not a discount. This is a premium. This means the stock is trading at a higher PE now. In conclusion, the stock is easily overvalued, as it trades 8.45 times their earnings, 3.58 times their yields, and 1.71 times their historical PEs. I don't own the stock. I don't think we should pay premium for the stock. I won't be touching this stock. I'd avoid this. The fair value is $43. This is when you multiply my first metric to my second metric. Here are my entry PEs, 8, 9, 10, and prices. This is when you multiply my assumptions to the current EPS. I tried using my multiples here, and still overvalued. I have here highest price of 75. It has to fall half the price. This is overvalued by 4 folds almost, if we're not paying a premium. Looking at charts, even with the pandemic crash, it's still overvalued. Look at this parabolic rise. There's no support here. If you had bought it below $80, I think you're in it for a long run. I won't advise adding at these levels. If anything, I'd tell you to sell to keep your gains, but yeah, keep your shares for the dividends. This 3 metric I use is designed to determine the best PE to buy a particular stock, as I believe PE is the price you pay for in a company. This is my process of screening stocks to buy at what PE by looking purely at the company's financials and none of their fundamentals. If you like to invest in these companies, I'd advise you to look at their fundamentals, their charts, and more of their financial data and metrics like long-term debt, some important financial ratio, etc. As always, do your own research.